All right. So first of all, let me thank you guys for coming out. This is the number 12th in our series on business data analytics, and which is the language of data. This particular, we started off, we had some foundational series items. We've recorded them all. So if at the end, I have a recording of this as well. This comes from, all of this is from the IIBA of Tampa Bay, the International Institute of Business Analysts, Tampa Bay. And what we've got going on is a meetup group with over 600 people. And if you get the chance, you want to join us, it doesn't cost anything. We do a lot of topics. And interestingly enough, I get people from all over the place. Anyway, so let me just talk about this front slide real quick. I got a lot to teach in a very short window of time. So you'll notice on the left-hand side of the slide, there is a parts list, like breakout of parts, almost like an assembly item. And each of those parts has a part number, again, like an inventory number. And that's a big part of what we're going to be talking about today. And at the bottom, you'll see two logos, the Object Management Group and the Financial Accounting Standards Board. And it's kind of really where we're going to be talking about is the relationship between those, meaning they don't have a formal relationship, but institutionally, if you are responsible for accounting and particularly for inventory within your organization, let's say you're a manufacturer and you are creating new things, chances are you're going to submit that information to the Object Management Group. And what they'll do is they'll include that as, it's like a clearinghouse of, let's say, part numbers. And the best example I can use is 40114011 in a grocery store, which represents bananas. And what we're focused on here is business data analytics. And if you're in the IIBA, the International Institute of Business Analysis, this is kind of not a major topic today, but it's becoming more major. It's included as, part of, like, you'll see where they talk about cybersecurity as kind of a corollary to what we're doing today, as well as transitioning from waterfall to agile, and then business data analytics. So it's not super popular yet, but it's picking up steam because of, well, the reality is that a business analyst job is shifting. Historically, we were product and process. We're still going to be product and process oriented when we go out and elicit requirements, but now we also have to be educated about data, particularly business data analytics. So I teach a class very quickly that is a requirements oriented class that's traditional: elicit, analyze, document, validate. The only difference is that, again, I spend more effort and time talking about data as in addition to product and process. So, I mean, I touch on product and I touch on process a little bit, but mainly it's about data. I also have a project management course, again, very traditional: initiate, plan, increment, execute, control and close, IPECC, or if you're, developer, envision, plan, develop, stabilize, deploy. But it also focuses on business data analytics. So again, I think I'm ahead of the curve here because I don't know anybody else that's doing this. So I started doing these because I felt like the world was changing. The IIBA has already embraced the concept of business data analytics. They have a credential now that you can get, a CBDA, Certified Business Data Analytics credential, added to your, job title, profile, whatever. A little bit about me. I owned a software company back in the 1990s. I'm not a developer. I always try to make the point that I used to pay developers. I'm the guy that wrote all the checks. And I had to communicate with the CFO of my clients, Chief Financial Officer. And that really taught me that no matter what job I was in, if I was gonna be successful, I had to speak the language of business, which is accounting. So I thought it was really funny that when I did this, when I set up this particular presentation and I put the word accounting in, I knew I wasn't going to get a big show out because, who wants to watch something about accounting? But if you're a business analyst and you don't speak this language, then you're just limiting yourself. That's all. I'm not saying you won't be successful. I'm not saying that you won't get a job or anything like that. But what I am saying is If you're interested in the future, and the future is data, then this is a topic that you really want to kind of dig into, because eventually the business analyst has to speak to two audiences. They got to speak to the business side, which is accounting, and they got to speak to the technical side, which obviously is their technical background. So that's what makes the job so interesting to me, is that a good analyst is jack of all trades, master of none. You can go, on one side you're accounting oriented, on the other side you're technology oriented. So I love the job. I think it's fascinating. It's endlessly fascinating to me. Anyway, these webinars are about seeking to understand, and so in this particular one, last week I talked about categorization drives organization and documentation, which drives integration, which leads you to automation. And if you look down the side of the screen, I've got all these humans until the bottom, and at the bottom I have the picture of a robot, which is Cortana, or what we like to say, intelligent assistants. Well, I'm not calling it artificial intelligence. That's another discussion that we're not really even close to yet. What we are as close to is, on a day-to-day basis, intelligent assistants. And how are the industries and the organizations setting up for that? Well, okay, so now we're going to talk about categorization, correlation, operation, control, and then I'm going to talk about something called the DuPont ROI model. So what are we really talking about here? Well, I mentioned that I had a CFO and my first client, and she said that there were only two kinds of numbers. It either had a dollar sign or it didn't. And when you think about it, that makes a lot of sense, because there are all kinds of numbers, but only one of those types of numbers actually has a dollar sign, some kind of a currency. Every other number, though, is non-financial. If that makes sense, put a yes. Meaning there's, every number that you're dealing with, time, distance, weight, those are non-financial numbers. So just type yes in the text chat, and then you'll get it. Okay, I just want to make sure that makes sense to everybody. So what no one ever told you, or maybe they did, but I'm going to remind you, is that all of these non-financial numbers correlate to some kind of financial result. So the best example I can use is when people say time is money. And while that's not necessarily a wrong statement, probably a better way to say it would be time, which is a measurement, correlates to money, which is another kind of measurement. And that was the thing. And what's kind of nice to know is that there's these standards boards out there, these groups that are nonprofit that are just trying to keep everybody organized. So in the United States, there are two groups that really control all the standards for accounting. There's the Financial Accounting Standards Board, if you are a for-profit entity, and then there's the Government Accounting Standards Board, if obviously you are a government entity. On the non-financial side, I'm only talking about the OMG. There are other groups. The OMG, the Object Management Group, is really more specific to information systems, information technology, and it focuses on standardizing objects from a software perspective, but it's very much tied to accounting. So I use the example of 4011 bananas. Well, if you're going to automate 4011 bananas as an object in software, you're going to continue to use the number 4011 so that you don't have to reprogram everything. You just converted it from a physical object into a digital object, but you kept the same inventory number. If that makes sense, put a yes. There are all kinds of ways to classify data items. Okay, I'm just talking about general business. Okay, cool, good. So let me give you an example. So institutionally, your institution has all kinds of managerial accounting codes, non-financial accounting codes. So this is just an example of how organizations like kind of organize, and they build out like these structures. I'm just going to use ZZOO, ZZOOOO, and then ZZOOOO, and what it's doing is you're building a work breakdown structure numbering system, which is a non-financial managerial accounting code that helps you organize and navigate through your institution. On the right-hand side are the standard codes that you normally see on financial documents. So for example, 1, 2, 3, the way I always tell people to remember is 1, 2, 3 balance sheet, 4, 5, 6 income statement. Now, 123 represents assets, liabilities, and owner's equity, or general fund if you're in a government entity. 456 is usually revenue, cost of goods sold, and overhead. Now, a lot of institutions don't manufacture anything, so they don't have a cost of goods sold, so they may just go as far as 5. But it's an easy way to remember it. And what we're saying is that the numbering systems start. So anything that starts with a 1, usually on a balance sheet, is an asset. Anything with a 2 is probably going to be a liability. Anything with a 3, like a 3 series number, it could be 300, 3000, 3.00, 3.01, whatever. And that's one way of understanding how we classify all the financial accounting codes through your chart of accounts. So I always tell people, if you really want to understand how an institution operates, what you want to do is look at their chart of accounts. That's another story for another day. But another example of managerial codes are the inventory codes that we use on all of our parts. If we're assembling parts, or if we're writing requirements that we can reuse, we would give them an inventory number. It could be as simple as a work breakdown structure number. And these requirements as inventory are reusable, which means we can assemble them faster than if we have to manufacture them custom. No matter what, they have to correlate back to the financial accounting system. So everything that we're doing, most of what we do as business analysts, is on the non-financial accounting side, the non-financial number side. This is the bulk of what we do. The accounting group handles all the accounting stuff, and most likely they're responsible for correlating that information back. But they are also going to be actively involved in your naming conventions, which we talked about last week when we talked about categorization drives organization through naming conventions. So you have employee numbers and department numbers and budget code numbers, and all of those things really do 2 things. They they organize us, but they also allow us to navigate. That's another story for another day. But so what exactly are we talking about? Well, if I take this concept of these numbers, and I say, hey, listen, in order to operate an institution, you have what we call 4 resources, or the 4 M's is the way to remember them. Okay, money, materials, and machinery are assets found on your balance sheet. Remember 1, 2, 3 balance sheet? Okay. And human power, instead of just manpower, human power is a expense found on your income statement. And this is really interesting to know, because when we're talking to people in the institution, we don't always see them necessarily as an expense that we're trying to make more efficient, but that's really where it's coming from. And these assets, so on the left-hand side, I'm with the non-financial managerial accounting, you have, department numbers. So the examples I'm using are like 501 sales management accounting, 502 marketing management, 503 manufacturing management. Well, that would be a cost of goods sold type of department, because they're a 5 series number. And then I have 604 engineering, 605 HR, 606 IT, 607 ops. Those would be your overhead expenses oriented categories. So, we tend to build these numbers to connect all these systems together. Great. So you can see the little smiley face. Those are my actor symbols in my little miniature use case there. So I've got an actor, and again, we'll teach that some time later. And I've got 2 use cases for this actor. And I have an input, and then I have a process, and then I have a decision, and then I have an output. So input, process, decision, output. And I've got 2 use cases. And you'll notice that on both of the, underneath it, I have on those little purple document icons, the use cases are green ovals, by the way. I have a little OMG and then the miniaturized version of the parts from the previous slide. And then under the red diamond, or decision diamond, I have Cortana. And if you look to the right, I have Cortana again as machinery. So let me explain what's going on. What we're doing as business analysts is we're converting what humans do operationally into code that can be run by computers. That's what we're doing. I mean, when someone says, hey, we want to automate a process, that's what we're doing. We're going in and saying, okay, what part of the process is repeatable can we program that so it runs autonomously without a human? That's what the intelligent assistant is there for. So as an analyst, our job is to elicit all of the requirements to do that. Now you got to remember that all the assistant is data. That's all it is. So our whole purpose of being as an analyst is to elicit requirements for building data solutions, regardless of ultimately what the institution does from an operational standpoint. I'll get to that here in a second. But just understand that on the right-hand side, so what I did is I took 1, 2, 3 balance sheet, and if you'll see that there's a light blue, rectangular box, it's kind of in what I call the landscape mode. And then I got a green box in a portrait mode, looks like kind of like a document. Well, it's called a balance sheet because really there's two sides. There's what we call sources of capital. And it's interesting that I start there because most people think you start with uses of capital, but you can't use any capital till you got some money to go buy it. So this is a little confusing to me when I first started out, but sources of capital is where the game begins. And those are your liabilities and your owner's equity. I won't get too far into this. And then uses of capital represent money, materials, and machinery, which are resources that we talk about anytime we go to do a project. Oh yeah, money, materials, machinery. And then underneath, you have an income statement. We have revenue, 4.0, and then cost of goods sold, 5.0, and then 6 is overhead. Remember, so I did the numbering. And of course, my cost of goods sold and my overhead is where my humans exist, the manpower, my human manpower, whatever. And that whole thing is how every institution operates. I mean, that's how they're set up. And regardless of what you do, whether you're government, non-government, everybody runs this way. This is how the machine runs. And what's fascinating is that a lot of business analysts don't know this. They have no idea. They're very technical. They can just tell you how the computers work, but they don't really know how the machine works. And the machine is the accounting machine of the institution. That's the most important machine. The computers are simply there to enable the accounting machine. And that's the point I'm always trying to get across to people. So every institution that operates really is a control loop, every single one. There's an input, whatever that input happens to be, which is the plan. There's a process, which is when you're actually doing all the work on a daily basis. Everybody's working every day in the process to generate some kind of an output. And the difference between what we planned, which is our input, and what we actually did, which is our output, is managed through something called control. So a control loop is input, process, output, control. And and that's the loop, that's the business loop. So you might say that your input is your sales, your process is, your assembly, and your output is delivery to the customer, whatever. Now, in the word control, you'll see the term variance analysis. And this is what drives the direction of the machine, which is the institution where you operate, is variance analysis. And this all comes from accounting. And so that was the other thing is when you get into this, you got to know at least a little bit about accounting. I mean, I don't need you to know debits and credits, but it's really useful if you have some idea of, plan versus actual. So let's talk about that for a moment. So this particular slide just kind of shows that I have this plan and it's kind of working its way down. And you'll see projects in red. And the reason it's in red is because when I teach project management courses, that's usually where we start a class, is right at the project level. And we never really explain how you get there. We just say, oh yeah, we have this project and now we want to break it into work packages, statement of work packages, or SOW packages, or statements of work, or scope, whatever you want to call it. And then we break those down. Those are nouns, basically. And we break those down into project tasks and project activities, which are verbs. So every institution basically is built around two things, nouns and verbs. That's pretty much it. And that's what's fascinating is in some institutions, the nouns are physical nouns. For example, if you're manufacturing physical product, you got a lot of physical nouns in your inventory. But if you're in the software business, then your nouns are electronic objects, snippets of code, objects. So, and then the verbs are whatever the work is to assemble the nouns into some kind of a solution. Pretty straightforward. What's interesting is that there are requirements for both nouns and verbs, but there's far more noun requirements. Why? Because you have to be able to describe everything on paper. So if you look around wherever you're sitting, there's physical product sitting there around you. There could be all kinds of things, lamps and chairs and the computers and the desk and all that. At some point, all of that had to be described on paper before it was ever manufactured. That's a requirement. That's what we do. That's a business analyst. And we don't necessarily do it so much as we elicit it from the subject matter experts who create it. So for example, there's an engineer who designed every single thing that you see around you. Even the smallest stuff, there's an engineer somewhere who's got a CAD system who designed like a pencil, all the different pieces of a pencil. There's probably an eraser, a little eraser on somebody's CAD system floating around in space. And you think to yourself, well, that's kind of an interesting job. How many erasers do you design? Well, it's not just they just design the eraser. They have to design the machine to manufacture the eraser. And those are all requirements as well. So the idea is that requirements is very hard. And I try to tell that to anybody that'll listen. I said, that's why we spend so much energy at it. That's why we always say, well, why did the project fail? Well, it was the requirements. Very, very difficult. That's the reason we exist as business analysts. Okay, long story short. Now let me come back to this accounting model. So the way it works is you got these inputs, and at the top of every institution are really three things: vision, mission, and goals. These are questions, and I don't have a lot of time to go into all this, but let me just say vision is what do you see, mission is who do you serve, and goals are what do you want. So if an institution says, hey, our goal is to be the best of the best of the best, I mean, that's a fine goal, except that it's pretty hard to measure. All right, so what institutions do is they baseline their organizations. And how do they do that? Usually through surveys. So they'll send out surveys to their stakeholders. Those are the people that you serve under your mission. And let's say you have customers as stakeholders, and you send a survey, and the survey comes back and it says 50% of your customers are happy with you. Then what that means is that 50% are not, and therefore you now have an objective, which is increased customer happiness, which becomes a capability. And then increased customer happiness, the measurement is based on the survey. So if you're at 50%, that's your baseline measurement. So you might have a target that says, hey, next year, we want to get to 60%. And the year after that, we want to go to 70%. The year after that, we want to go to 80%. So starting with a goal, starting with stakeholders that you're going to pursue and elicit information in the form of a survey from, you've now just created what we call an objective, a measurement, and a target. And those three things together really are high-level business requirements that are measurable in the form of key performance indicators. And see, this is what's cool, is that the requirements start at the top, right underneath the executives coming up with what they think they want. Now we have to have specific requirements on how we're going to meet or exceed those goals. Anyway, once we have those hard measurement goals, most of them are non-financial, right? Increased customer happiness from 50 to 60%, that's a non-financial goal. If that makes sense, put a yes in the text chat. That's a non-financial requirement. It's a non-financial goal. Okay, cool. So what this does is this explains, oh, these are called weighted scores. And later on, I'm going to teach you a little bit about how portfolio works in a future session. So you got these weighted scores against your portfolio, and portfolio basically means money, and then out of that money, it's distributed across usually departments in the form of programs, and then it becomes projects, and then those projects are broken into scope work packages that are broken into, which are nouns broken into verbs. Okay, great. You'll notice at the top of the screen it says variance, and then to the right there's a big red box that says actual divided by plan equals. Okay, and that says 1 equals green. So I'll talk about that here in a second. So most institutions have a plan, and I always try to tell people the purpose of a plan is not simply to act as a to-do list. Well, while that is a use of the plan, the purpose of the plan is that it acts as a measurement or a baseline to measure actual. So you think it's going to take an hour, but it actually takes you 2. There's a variance. Or if you think it's going to take you an hour and instead it takes you 30 minutes, there's a variance. And the variance allows you to improve your planning process. And the idea is that every time you iterate through your cycle of planning and you reuse historical plans over and over and over again, you develop a better estimating process. Ultimately, what I like to call is parametric estimating, which is where you've got a lot of historical data in a database. Oh, data, business data analytics. Yes, we use historical data to predict future outcomes. And this is where it all begins, right here on this variance chart. The more plan we have, the more data we accumulate against the plan, the smarter we become in figuring out how to improve against our variance numbers. All right. Later on, I'm going to teach you earned value EZ, and that really makes this, I make it much more practical, like how do we use this on a day-to-day basis? But I just wanted you to understand this concept of plan versus actual variance. Okay, institutionally, there's something called the DuPont ROI formula, okay? And it was created by a gentleman named Donaldson Brown in 1912, all right? Now, without really spending a lot of time on this, because again, I'm past my time because the machines were acting weird. The thing I want you to take away from this slide is that, and I just showed the first three boxes, that return on investment is actually known as return on invested capital. Okay, there's many different ways to measure return on investment. This is the DuPont ROI way, okay? And DuPont is the DuPont family, DuPont Corporation that goes way back to like the 1800s. So this was created in 1911 after they'd been around for over 100 years in the United States. Anyway, long story short, ROI is actually an output of two numbers. One is called turnover, which has to do with your assets. And most people think when I say turnover, they think of inventory turnover, which is one line item on your balance sheet. That's correct. But this turnover number really represents every single line on your balance sheet that's under uses of capital. Okay, and I'm going to give you an example of how this works here in a minute. At the bottom, underneath it, it says return on investment is turnover multiplied times earnings as a percentage of sales, which is also known as profit or efficiency if you are a nonprofit. So I'm always trying to tell people, and I mentioned this in a previous session, that every business, because of the cost of capital, the original cost of capital known as inflation, has to generate at least 3% every year just to keep up with changes in valuations of their internal cash flow, okay? Your cash becomes less valuable over time because the price of products goes up, right? So this is, you have to become more efficient to keep up with that, all right? So let's take this DuPont ROI formula and let's kind of turn it into just some quick numbers. And I'm going to use the example that I wrote in an article that's posted on my LinkedIn profile if you want to ever read it. It's about liquidity helping you understand methodology. Okay, so, and using the DuPont ROI formula. So every business that uses this number, first of all, the number comes from, the idea behind this number comes from something known as the rule of 72. And the rule of 72, you can look this up on Wikipedia. Just look up rule of 72, you'll find all kinds of information about it. But basically, the rule of 72 says, if you have a 1% return on investment, it's going to take you 72 years to double your money, roughly. If you have a 2% return on investment, it'll take you 36 years. If you have a 3% return on investment, you're looking at 24 years. And if you have a 10% return on investment, it drops all the way down to 7.2 years. Now, you can flip that model, and you could say, and again, these are heuristics, not algorithms. If you need to double your money in 1 year, you need to get a 72% return on investment. Or if you can wait 2 years, you only need a 36% return on investment. If you can wait 3 years, you only need a 24%. So I've got a red box around 24 because that's a pretty common number that a lot of institutions use as a target for DuPont ROI, is a 3-year ROI. Now, how does that work? Well, it really depends on the kind of industry that you're in. And the industry is the materials and the machinery that you use to operate, otherwise known as your equipment. Okay, so for example, let's say you use a sports team as an example. In the basketball industry, basketball players use basketball equipment. They don't use baseball equipment. They don't use hockey equipment. They don't use football equipment. They use basketball equipment to play basketball, right? Same thing with the baseball industry. In the baseball industry, baseball players use baseball equipment. They don't use basketball equipment or football equipment or hockey equipment to play baseball. All right. The industry that you're in dictates the equipment that you're going to use. So if you're in the oil and gas business and you're drilling offshore oil drilling platforms, you're going to use different equipment than if you are building aircraft carriers. I mean, some of it will be the same, but predominantly it's going to be totally different. Your inventory is going to be different. I mean, your tools might somewhat be the same, but you'll have specialized tools for your industry. Okay. The more physical equipment you have as a company, the less liquid you are. If you have warehouses and physical inventory and physical equipment, that stuff, especially if it's industrial, is not easy to sell. It's not real liquid. Okay. The opposite is if you're like Google, let's say, and your only inventory is really you don't have any. You auction keywords. Then you're very liquid. You're very, very liquid. Now, let me give you 2 examples, and I'm going to show you both sides of the equation, right, really fast. Low liquid versus high liquid. Most institutions, the vast majority of them that do anything that's physical, like distribution or manufacturing or whatever, are generally low turnover, low liquidity, meaning the way it's set up under uses of capital is the most liquid thing is money, then materials, and the least liquid thing is machinery. So if you have a business that has a lot of machinery, like heavy machinery, you're not going to be super liquid. Airlines, for example, not very liquid. Why? Because they have a lot of airplanes. All right. What that means is to get to 24% ROI, let's use an example where your turnover is 1, which means to get to 24%, you got to be 24% efficient. What does that mean? For every dollar of revenue that you generate, you must hold expenses at 76 cents in order to get to 24% return. Now, that's really not easy to do, is to constantly try to hold expenses. That's why every year you hear do more with less. That's why you got to focus on reuse. You need to reuse as much of your stuff to simplify the process of remaining liquid over time. Okay. Let's flip the tables and talk about Google. Let's just flip those numbers. Let's say instead of a turnover of 1, which means you're not liquid, let's go to a turnover of 24, which means you're insanely liquid. Okay. Generally speaking, turnover is annual. So it'd be like you turn most of your assets once a year. Whereas in a very liquid shop, like let's say Google, you'd be turning your assets, twice a month, 24 times a year. All right. In that scenario, for every dollar of revenue that you generate, you only have to hold expenses at 99 cents. Why? Because you're so liquid. You have so much cash moving through your system. And see, this is what's interesting, is that a lot of analysts and a lot of companies don't really understand the relationship between the balance sheet and the income statement. They're not mutually exclusive. They're actually tied together with this formula. And the output, again, of your balance sheet is turnover, and the output of your income statement is efficiency. And those two are multiplied together to give you DuPont ROI. So for example, let's go back to this turnover 24, you're highly liquid. If you think about it, Google spends all kinds of money on people. And lots of changes don't bother them. They're fine with a lot of change. If you're in an environment that has a very low liquidity, means that you have to be super efficient. That means change requests are a big deal to you. So I bring this up because I talk about, assembly methods like waterfall versus agile. When in a waterfall environment, depending on what you're manufacturing, you might be very low liquidity. So you have to be super efficient in the way that you operate. And that you're what I call anti-change. This is, you don't like changes. Changes are like the worst thing ever. Unfortunately, agile embraces change, and not in a negative way, but just that's the methodology. So sometimes these companies that are trying to embrace agile, which I don't have a problem doing it, but the idea is that they haven't really talked about the fact that they're low liquidity organizations. So they're struggling with embracing it because they're fighting change at the same time that they're embracing an assembly method that completely embraces change. I mean, that's, Google's all about changing quickly, often, et cetera, et cetera. So again, just understanding how your shop is set up kind of help you sort of dictate your methodology. On the flip side, the blue items, where I'm recognizing the high liquidity organization, in that kind of environment, you can spend all kinds of money and still come out with a high return on investment. So change isn't going to affect you as much. And so it's funny because I've taught classes in Silicon Valley to very wealthy companies, and they're not as interested in efficiency as you might think, simply because they don't have to worry about it. They got a lot of cash in the bank. And I've taught very low liquidity organizations like Cooper Tire in Toledo, Ohio, that's been there for 100 years and has like all this heavy equipment, and they're very focused on efficiency. And it's funny too, because if you get the opportunity to go in two different kinds of institutions that are opposite of each other, the ones that have low liquidity usually have really old carpet and furniture. And I always laugh about that because they're saving money. Whereas you go to these high turnover companies, meaning liquidity wise, not employees or things like that, but just their liquidity is really high. They're a cash-based, money's just flowing through their shop. They give you free food. They got these free machines for like anything. You make your own meals. They get, free espresso and all that kind of stuff. So very interesting. And it has to do with the fact that the assets, the equipment that they're using in a high liquidity organization tend to be intellectual property more so than physical assets. But they all have to be numbered, and they're all requirements. And that was the thing. And that was really kind of what I was trying to get you through today. So I apologize for the delay. So in summary, let me just kind of go back to this. As an analyst, especially with business data analytics, it's really important that you recognize that how your organization categorizes. That's the first thing that I'm always trying to get people to do is explain to me your file naming convention for everything, not just labor, but product and everything. And an analyst, a good analyst, needs to go dig through and possibly meet with the folks in accounting. People try to tell me, well, we don't have a way to categorize that. And I'm like, I bet you do in accounting. So in your accounting department, they kind of are the keepers of most of the categorization information within an institution. So I'm always trying to tell people, don't reinvent your wheels. Don't come up with new naming conventions or new numbering schemes if institutional ones already exist and maybe you're just not aware of them. So try to seek those out first. Recognize that all these non-financial metrics or numbers or categories all correlate back to financial accounting results. Why is that important? Well, because as we move into business data analytics, the business analyst has to work with the stakeholder client to come up with key performance indicators that then work backwards from the financial side over to the non-financial side. So on the business side, they're coming up with KPIs, and our job is to take that information and then decompose it or abstract it all the way down to the non-financial side to make sure that our requirements are set up properly so that when we build the solution and then we test all the way back, all the way, because at the user is user acceptance testing. At the very most functional operational level, it's unit testing. Whether it's a physical product or whether it's intellectual property, it doesn't really matter. Then the other side to understand is that institutionally, the institution operates, all institutions operate under variance analysis, which is how they control the machine. And they always use historical data in order to predict future data. So again, in the future, I'm going to teach you earned value, how that actually works, where it's set up, status, and forecast. But what I need you to take away from this is that this concept of how this machine runs is built around something called the DuPont ROI, that the financial side has been set up for many, many, many years, that this isn't some new thing. A lot of people don't realize they either focus on their income statement or they only focus on their balance sheet. Generally speaking, those are connected. They're really ultimately the same document, but that's another story for another day. But understand that they're used to correlate, or excuse me, they're used to control the institution, that there's a plan and an actual for every single component as you work your way through. That's what the DuPont ROI formula shows you, is that as you decompose the financial side down, at some point it has to all correlate back to the non-financial requirements, inventory, intellectual property, physical property that we're using to assemble to then roll that data back up to have financial results. And all of this ultimately has to be mapped out very clearly in order to enable intelligent assistance. And that's where there's a huge opportunity for us as business analysts, is recognizing that a lot of this stuff isn't mapped out in a way that the machines can take advantage of it. It's in people's heads, it's on documents that are written, but it needs to be in the system, in software, so that the machines can read it, hence learn from it, machine learning. So this is our future. I you know, for a lot of us, not for everybody, but for a lot of us, if you're doing business data analytics, this is kind of where it all goes, and all these pieces connect. Okay, so that is it for that. Are there any questions? Have you got any questions on this? I threw a lot at you. Normally this would take me hours to explain, so.
I was going to say, I do have a question. I was going to put this in the chat, but I wasn't sure. But it was right.
Well, I appreciate that, Bob. Best session so far. I put a lot of structured meetings and stuff I already knew, but I learned the most I didn't know. Cool, good. That was the key. And we mentioned that at the beginning. So all this stuff is going to take you down this journey. So, and it's all open source. Again, I send out the slide decks. Ignacio, I know you're going to send me an email, so please do. Anyway, let's stay in contact with each other. If you are not connected to me, you can reach me any number of ways. 214-755-7035, talk or text. That's a Dallas number. I'm actually located in Florida, but my company's still in Dallas, and I just leave my number there. rfrederick.pmp@gmail.com. If you want a copy of the slide deck, just send me an email, slide deck, and I will send it right back to you. Please join our meetup, meetup.com, Tampa Bay IIBA. And if you want to connect with me, I ask that you send me an invite. Just let me know you were on this webinar, and happy to become a part of your network. Actually, very humbled to become a part of your network. www.linkedin.com/rfrederick. If your organization eventually decides that they want to do something on business data analytics, I hope that you'll kind of think of me first. Give me a call, set up a meeting with me, whatever, and we can go from there. So meetings.hubspot.com/rfrederick-PMP. So there's a recording of this. It'll be up today onto the meetup site, and so you'll be able to access this. And again, all this information is open source. Please share it with whomever you think. That was why this says train the trainer. Forgot to mention that. So Mike asked a question: how do you do return on investment when you have a company that does both technology and manufacturing? That's a great question. So you want to communicate with your accounting department, and remember that the manufacturing is the primary role of the institution. The technology, I'm guessing, is there to either automate the manufacturing or to provide information data to executives. I mean, outside of the corporate staff, people that are doing that stuff. So you're going to have different ROI numbers that are going to ultimately come together. But the main thing is, you as a business analyst, you're not really going to be doing necessarily return on investment. It was mostly to kind of explain how your executives are doing it. But again, you might be, and if you are, man, that's awesome. But you'll have different ROI numbers, and they all kind of come together. I don't know if I answered your question. I work for a company that did both solutions, but wondered if ROI for manufacturing drove our efficiency. Possibly. Yeah, possibly. You know what it is every company's a little different, and they're going to do, your executives make decisions different ways. There's a great book. Let me write it down for you here. It's called The 5-Minute Manager by Carol Simons. Okay. And I think it's called The 5-Minute Manager. I think so. Hang on, I'll tell you what it's called. Oh. That was someone else's book. This book, I don't know, can you guys see this? Is my screen showing up? It's called Millionaire Manager. Yes, okay. So let me write that down. Millionaire Manager. Excuse me. I said 5-Minute Manager. That's like, that's a different book. All right. And Curtis W. Simons, which is really how I got going on a lot of this. Okay, so this book isn't even thick. I mean, it's super thin. You can get it on Amazon, buy it used. It's like a parable. It's like a story. It's told in like a story format. But this book is an MBA, literally, because once you understand the DuPont ROI formula and you understand how the income statement and the balance sheet are connected to each other, then you can begin to really look at how the institution operates as a machine, and you can start to see how the two affect one another. That's really useful as a business analyst, because as the institution asks you to go elicit requirements, you'll be able to start putting these things in the right places piecewise. You go, oh, this piece goes here, that piece goes there. So yeah, all the different, like Bob says, different projects and efforts can all have independent ROI calculations and standards. Absolutely. And ROI is different for different people. So you're going to find that out as you're going through your process. But DuPont ROI is just an old school method of connecting your balance sheet and your income statement. So anything else? This is fun. I'm so glad you guys came out. Who showed up? 1, 2, 3, 4, 5, 6. Yeah, I thought it was pretty short. So I'll get geeky again, technology wise. I felt like you gotta have some of the business side of it going on. So invite more people though. Just bring out more people. I love having people show up. So, and again, joining the IIBA meetup is free. We don't charge anything. So hopefully. Yeah. You know that book? Yeah. You can get a cheap, just look for a cheap version of it. Yeah. It's really, I promise you, I got a cheap version. Originally it was like $75 for this little book. I was like, you're just nuts. But yeah, if you keep looking, you can find like a used one. So, but it's a good book. It's one of the better books out there. So, yeah. Anyway. All right. Well, then we're done this week, and we will talk to everybody again next week. So thank you all for coming out.